everybody. Luke Gromen, FFTT. Hope everyone had a great weekend, and weather was hopefully a nice one for everybody. Before we jump in, I'm going to have a real quick testimonial on tree rings. Luke, you've outdone yourself again this week. You're making some outstanding connections that I'm not reading about anywhere else. Thanks again for valuable insights you provide and for helping to keep our eyes on the forest. That's from Nick H., a Tree Ring subscriber. So if you like these updates, I really think you'd enjoy Tree Ring, so check it out on our website, FFTT-LLC.com. And so with that, we're going to jump right in here. First question from Mark. What are the chances the dollar spikes higher before going lower? What would it take for this to happen? I think the odds they're very good chances. I don't want to be flip, but you just need the Fed to not grow their balance sheet as fast as required, and you should start to see the dollar rise again. We last saw this in the January-February timeframe when you saw the Fed balance sheet just stop growing. They weren't even shrinking it; they just stopped growing it. And we at the time had turned more tactically cautious. We were caught by surprise by COVID, by how severe that was. But basically, at this point, you now need the Fed balance sheet to grow really aggressively. And if it doesn't grow enough, if the Fed does not supply dollars to whatever markets need them aggressively enough, I'd expect to see the dollar spike again, and you'd likely quickly see markets break again, including Treasury markets. Obviously, equities, emerging markets would go first, but something that was important was from March 9th for the next week or so, you saw Treasury markets, spreads blow out, Treasury bond market crash almost as fast as equities crashed from that point. And the Fed's own minutes from the March 15th meeting said that, quote, the Treasury market stopped effectively functioning. And so that is a long-winded answer, but the bottom line is a dollar increase is still very possible. I think the key dynamic is what's the Fed do? How fast do they grow their balance sheet? Do they grow it as fast as needed? And that's a dynamic number based on how the economy is slowing or rebounding, etc. Next question comes from James. Could you please describe the similarities between Japan and the U.S. in terms of central bank buying? How much of U.S. bond and stock market will become nationalized or state-owned, and over what timeline? The dynamics of what the U.S. is doing relative to what the BOJ has done over the past 8 to 10 years has been pretty similar. The one thing that's different is the Fed is doing it an order of magnitude faster. So what it took the BOJ to go from 20 to 30% took them about 5 years. The Fed did it in 6 weeks. The reason for that is the underlying dynamics are very, very different. This is important. Japan is a current account surplus nation. They are internally funded. They fund from their own country. They have a massively positive net international investment position. So they have more investments offshore than other countries own of their own domestic assets, and so it's basically positive investment flows to them. And what this, in contrast, the U.S. has twin deficits. Up until recently, we were externally funded. We still are a little bit, but a lot more of that is having to be funded by the U.S. And it was the U.S. has a massively negative net international investment position. If you go back to the 2008 when we went into that recession, the U.S. NIIP was -8%, -9%. Now we went into this one -51% of GDP. Okay, so in plain English, what this means is that the Fed is likely going to have to buy not just current Treasury issuance, but historical Treasury issuance at a much, much faster rate if the Fed wants to stave off an economic collapse, a dollar spike that'll crash both stocks, the Treasury market, emerging markets, and in Japan, BOJ's really just buying JGBs on net from their domestic sector. So basically, the Fed's got to buy aggressively from the world, or else the world will have to sell treasuries that they've stockpiled over the years to raise dollars, and that's what you saw start to happen that led to that Treasury market crash back in mid-March. From TM, can you give a point of view on TIPS, Treasury inflation-protected securities, Would they benefit from the same dynamics that benefit gold and equities? In the near term, they could. The problem with TIPS from a longer-term perspective, from my perspective, and why I don't personally own them, is because it's a matter of U.S. national security to understate inflation significantly. And this is not just a U.S. thing. This is sovereigns historically, when they get into fiscal trouble, they understate inflation. This goes way back. You go back to Roman times. You hear stories of clipping coins, right? The coins we still have today, quarters, have ruffled edges because that was how you could. That was the solution to ensure or give confidence that the coins were not being clipped. And so this, it's a matter of national security for nations in sovereign debt problems to understate inflation. And so I wrestle with tips just that, are they going to truly reflect what inflation is when it's in the interest of the government that they don't. And so that's the challenge. That's a challenge I have. That said, this process of clipping coins, if you will, understating inflation, is all. It can also be managed with paper gold markets. Has been managed with paper gold markets, and so it's part of the reason why what we're watching in gold markets over the last month in terms of some of the physical disruptions, spreads of the futures over spot markets, etc., have been so interesting. Especially since a rising gold price, we think is now in the interest of a number of different governments, including possibly the U.S. From OD, if CARES Act provides $450 billion and banks leverage it 10-1, Fed backstops losses, isn't this the same as the Fed functionally printing $4.5 trillion? In my opinion, it's not an exact perfect, but sort of. It is a potentially. I think the best way to think about it is a potentially significant injection of near-term liquidity relative to the size of the economy. But at the moment, right now, they're just basically filling in a hole. And so we've had this collapse in GDP. You've seen estimates anywhere from down 20 to down 40 or 50% GDP. I've seen here in the second quarter with the shutdown of the U.S. economy and the global economy relative to COVID. We've got this massive hole we need to fill, and so these types of these actions are basically just trying to fill in that hole. And so I don't think it's necessarily have an inflationary impact, beyond psychologically at the moment. It may start to be a bit of a different story once we get back, get the economy back, get some acceleration, maybe some velocity of money. But that's something we'll have to see from that point. And then the last question from Max is: a lengthy and/or deep recession or depression necessary in order to get through a reset of the global financial system? Historically, you've needed political cover for major changes or some sort of crisis, and so whether that is done in a premeditated way or whether that's simply sort of as a result of what happened. The sovereign debt bubble bursts when the next recession hit. We thought that was going to be the case. You've seen the Treasury market act in a very different way than it has historically in crises that we were talking about earlier. The overriding theme is that you need that level of desperation basically to get those most attached, those most benefiting from the status quo, willing to move to something new. Or, in plain English, there's no atheists in foxholes, right? So there's no capitalists in crises, as we're finding out. So I think you need some sort of political cover. From a mathematical standpoint, we've highlighted in our work a number of different times that in the next recession, you are likely to see the deficit blow out to really eye-popping levels, and we've not been disappointed. They have been very eye-popping. Now, it's a special case. This is a doozy of a recession with a external forcing factor. With that said, look, it was the snowflake that triggered the avalanche. So, ultimately, I think you're going to see some of the, it's putting the pressure on the system. It's forcing the balance sheet growth in the Fed. We'll see how it develops from there. So I don't know that it was an exact answer, but hopefully that helps in terms of thinking about it. So with that, we are going to jump off for tonight. I hope everybody has a great night and look forward to talking with you soon. And again, if you enjoy these updates, check out FFTT Tree Rings. You can find out more about it at FFTT-LLC.com. And look forward to chatting with you all soon. Take care, everybody.